it's a great product for someone that doesn't necessarily want to show their tax returns, that type of thing, or go through the hoops of a full qualifying income analysis.
Welcome to another edition of Tuesday Tips. If it's the first time you've been to my channel, my name is Lee Brickey, and I am joined again today by Brent Starts from Unitas Lending. And today we're talking about real estate, money, and mortgages. And that's what we talk about on this channel. So today we're talking about loans for second homes and loans for investment property. And we're talking a little bit about the Port St. Lucie market and what's going on now in it, because recently we've had a little bit more supply of homes, and homes are sitting on the market just a little longer. And we have noticed that there is less bidding war. So it is the optimal time to purchase a property right now, I think, in Port St. Lucie, so that you can get in there, get the property you like, and have a little bit more selection to choose from. So with that being said, Brent, what is happening with these new mortgages that we've been talking about for investors and second homes?
Yeah, investors and second homes. A couple changes just this week. Fannie Mae, Freddie Mac, the two government-sponsored enterprises, GSEs, they've been in conservatorship by the federal government for over 10 years now, 12 years. But what they've done is they've increased the cost of those types of loans for second homes, investment properties, for standard bank loans, if you will, the Fannie, Freddie conforming loans. And so it's really kind of increased the market share of the debt service coverage ratio loans, and a kind of a competitor to that type of loan, where it's a great product for someone that doesn't necessarily want to show their tax returns, that type of thing, or go through the hoops of a full qualifying income analysis. What we do is we look at the property. It's a make sense loans. What I like about it, it's a loan whereas they do an appraisal of the property. So the value is there. You have to have a relatively good credit score, and the rental income of that property, we do a rent survey when we do the appraisal, and as long as the rent covers that mortgage payment and the cost of the home, the principal, interest, taxes, insurance, and any HOA, that's the basis for the approval.
And so what's the rate running on this loan right now?
Yeah, it's hovering about a half point higher than the conventional rates, conforming rates. So we're in the mid fours right now for a loan like that. Mm-hmm.
Okay.
And that's a 30-year fixed. Okay.
And so this, and if someone was buying a second home, what would their mortgage be on that?
Yeah, in a second home, there's a little adjustment there now with the LLPA's loan level pricing adjustments is what it stands for. And those are the set adjustments that all lenders have that sell to Fannie Mae and Freddie Mac. In other words, all the bank loans, or paper loans, some people call them, or conforming loans. And so you're looking in, in the fours right now, the very low fours for something like that right now. And that's with the, standard credit income, that type of thing. Of course, everyone's situation is different, but to give you an idea, all things being the same, the DSCR loans are about a half point higher and fixed for 30 years as well.
Okay. And then, and so they're about the same then if you're buying a second home, correct?
Yeah, that's exactly right. A lot less hassle, a little faster, so especially for self-employed borrowers, because they've got, some documentation. Some of that's been changed very recently, as far as the requirements for a self-employed borrower. We no longer have to have, last 3 months bank statements, for example, showing that you're still in the same pace. So some of those COVID restrictions or COVID overlays, credit overlays, have been removed this last week as well.
And that's something, just to jump off this real quick, a lot of people are really upset about rates going up, but as rates start to tick up this year, we're going to see banks and lenders starting to ease back on requirements a little bit, making it a little easier for buyers to qualify. Am I right in saying that?
That's right. That's right. Now, the LLPAs are making it a little more difficult for investors from the conforming loan standpoint. In other words, the bank loans that are kind of backed. I hate to say it, but they're really, conservatorship. Basically, the federal government's running the show on that. So conforming loans these days. And so what the belief is, they're going to make it easier for primary home buyers. And when you're buying your primary residence, it's designed really for primary homeowners, not to help, if you will, investors. The mandate of the GSEs, the government sponsored enterprises, Fannie Mae and Freddie Mac, is to make homeownership more affordable for homeowners, and primary homes is the primary goal.
Right, and that's where this investment loan comes into play. Much easier to get. On the qualifications on this, what are the qualifications for this?
You must own your primary residence. So in other words, it's not designed for someone to buy their primary and say that hey, it's an investment property. So that's one of the requirements. Another one is some of the investors that purchase these loans go down to a 620 FICO score with a little higher down payment. That's the other thing that's a little different. There's a 20% down payment with the DSCR loans, and so that's another requirement. There is one investor that will accept a 15% down payment for an investment property, but the rates are substantially higher because they're additional risk. So be thinking, 20% down is what you're really looking at there.
There's also a way that eventually they can put down less money on another home, and also they can move this loan into a interest only loan. Tell me a little bit about that.
Yeah, absolutely. That's one of the qualifiers. That's a great point, Lee. I'm glad you brought it up. There is an interest-only option on these loans as well, and let's say that it's a close to a break even, but it's not quite showing a break even analysis where your 1-to-1 ratio is accomplished. Then we can go with what's called an interest-only option, where you're not paying the principal down, but just the interest only on that loan for a year. What you do is you take, roughly 4.5% multiplied, by the loan amount. Let's say it's $100,000. That's $4,500 divided by 12. That's your monthly payment. So that's all your rent would have to be per 100,000. So if you're looking at a $400,000 home, you're looking at a pretty low payment to qualify, because the rent would easily, in the market that you work in, primarily, for example, Port St. Lucie area, you're going to see that cover the payment and then some, quite a bit. Right. It'd be a nice cash flow, and that's for 10 years, by the way. And it's a 40-year loan, so actually it's 10 years interest only. So you're going to get a much stronger cash flow from an investor standpoint, and then it converts to a fully amortized 30-year loan. So if you look back where rents were 10 years ago, and you extrapolate forward, where 10 years from now, where rents would be, using the same percentage, you're going to find that you got a great cash flow for 10 years, and you got a wonderful investment for the following 30. It's a great strategy.
Now, what if my rate is 4.5%, and after the 10 years, I'm still going to be at 4.5%?
That's right. Sticks.
So it's an actual locked rate. So your interest only for 10 years on a locked rate, and then you have another 30 years at the 4.5%.
That's exactly right.
Well, that's a great deal.
It is. And if you look at the historical interest rates, the average interest rates over the last 70 years are about 6.5%, 7%.
Well, over the last 10 years, they're in the fours. So, that's where I think we're heading towards, the end of the year or next year. I believe we'll definitely be in the fours, and that'll be more of a normalized market, I believe, also for folks out there. We've had a few comments from my YouTube site and from some clients that are wanting to get into the rental market in Port St. Lucie, that they've missed the boat. The equity in the homes in Port St. Lucie for those, for the 7 years that we've been selling there, have steadily gone up 10% a year. And it's continuing to go up. Now, we've seen double-digit numbers, way higher than 10% over the last couple of years here, but I would say that we're going to continue to see this 10% a year for a long time. And if buyers and investors are looking to get into the market, there's still so much more opportunity for buyers and investors in the Port St. Lucie market, because number one, there's so much growth in the market right now from all of the companies coming in. All you have to do is drive on 95 from Becker to Midway Road, and you'll see the buildings and the ground being torn up on both sides from FedEx, Amazon, and all the other companies that are coming in and building their facilities there. They're expecting 25,000 jobs to be created. Tradition's talking about becoming its own city. I mean, that whole parkway is being torn up. I mean, on both sides of the road, they're building new office buildings, new restaurants, new neighborhoods. There's also a new downtown going in. So, and if we're looking at the market update from December, there was 452 homes on the market. The median home price was $350,000. So that is, and you know, it's not a lot, but we were at 0.8 on supply. So we're almost at a month's supply of homes. We're a little bit less than that. But what we're seeing right now, especially from January to February, we're seeing the market kind of changing just a tad, where we have less people bidding on the same homes. There's homes available right now for people to buy. There's new construction coming back on the market. I think that's due to rates going up. Some people are having some issues with that. We've talked about that in our past videos, where we've been able to help a few of our clients and some other people with that are reaching out to you that are buying new construction, but the builder's rates are higher than what you would offer someone. So, you know, the opportunity for Port St. Lucie is going to be there for a while, because people moving to Port St. Lucie are moving to Port St. Lucie because they can't buy in Palm Beach County, or they're coming from Palm Beach County to Dade County up to Port St. Lucie, selling their homes and to buy lesser home and have less traffic and noise in their life. So that market is going to continue to come. Plus, we're getting calls every day still from people coming from other states all over the United States coming to Port St. Lucie. So, you know, you're talking about almost 40 to 50% less for a home in Port St. Lucie than you would buy in Palm Beach County. But we're also looking at about the same rental prices on these homes if you're buying as an investor. And if you're buying as a buyer, then you're getting way more home than you would in Palm Beach County, and you're having an opportunity to get in brand new construction at half the price of what Palm Beach County would be. So there is tremendous opportunity in Port St. Lucie. We've been in it for a long time. Anyone who wants to build a rental portfolio or purchase a home in Port St. Lucie, I was just talking to a friend today, and she's like, I don't know what we're going to do. And I said, go to Port St. Lucie. You know, it's half the price of Palm Beach County, and you can get a brand new home up there for, you know, $500,000, which it's not even, you can't even get close to that here in Palm Beach County. You'd be at over $1 million for the same size home. So that is not going to be an issue for anyone that's looking to buy or start a rental portfolio in Port St. Lucie, and I'm sure you agree with that.
Oh, absolutely. I think, you know, one of the things I've noticed, because, you know, I lived in California for 23 years. I've been in Florida for 12 now. And the appreciation, home appreciation, is tethered to wage inflation, right? The rate people are paid. What we're creating here are higher paying jobs. Companies are moving here, and we're also seeing people, you know, moving from the Northeast, moving here and working from home, things like that. That's what I'm seeing on the front lines anyway. People are transferring and working from home. Why should they live in New York and, you know, have a over $1 million home if they can have the same home here for, you know, $400,000? Just doesn't make a lot of sense to carry that cost. And then you figure in the taxes and things. And so that experience I had in watching, you know, because I moved from the Midwest to California in 1987 and watched how far appreciation and housing could go. And I'll tell you what, you have multi-generational housing arrangements, renting rooms out. You'd be surprised at some of the things people do to afford a home, because it's really obviously the primary need and desire for long-term wealth. So people want to get in on it, and so I think we have a lot of room to run yet, and especially in Port St. Lucie and in Florida in general.
If you'd like to get more information on the DSCR loan for building a rental portfolio, or you'd like to talk to Brent about rates and what he can do for you, I'm going to leave his information in the information section below. As always, reach out to him directly. He'd love to help you and talk to you and see if he can guide you in the right direction. And if this is your first time to my site, please don't forget to slap that subscribe button right there and ring that notification bell so you don't miss any of our real estate tips and tours. And you can watch our next video on the Port St. Lucie market right there. And if you'd like to watch our home tours, you can do that right there. Be kind to each other, and we'll see you next time.